Bank loans are financing. Hi guys, welcome back. Let's have more on financing the working capital. So we ended with bank loans. Remember, bank loans are financing sourced from banks. The cost of financing is stated, or is it? If you can recall, we have issues on the true financing cost. The true financing cost is not necessarily the same as the stated interest, considering there's a chance that the terms would include discounting and compensating balance. Let us proceed to more complex cases. Let us assume that we're going to have a loan outstanding for half a year, combining the impact of discounting and having a compensating balance requirement, and more. YMD Corporation wishes to borrow funds amounting to 10,000 pesos from GNB Incorporated at an annual interest rate of 10%. Now, what is the effective annual rate if it is a discounted loan due in 6 months? So if you can remember, when the terms would include discounting, interest would be deducted at the beginning of the term of the loan. Whatever that amount of interest is, it will be netted against the principal upon initial disbursement to the borrower. So we would have an effective annual rate of numerator, this is the interest, 10% times 10,000, but this time it is only good for 6 months. So times 6/12. We are going to divide this by the principal, 10,000, less the interest, 10% times 10,000 times 6/12. And since this is only interest good for 6 months, we're going to make an adjustment. Let's annualize it by multiplying by 12 divided by 6. That would give us an effective annual rate of 10.53%. This is how we're going to deal with discounting terms, assuming that the loan is outstanding only for a fraction of a year. Next, same case. What is the effective annual rate if it is a discounted loan and has a compensating balance requirement of 1,000 pesos? In this case, we have to combine the impact of both discounting and the compensating balance requirement. The effective annual rate is 10% times 10,000 times 3/12, considering the loan will be outstanding only for 3 months, divided by 10,000 less 10% times 10,000 times 3/12 to account for discounting, and further less 1,000 the compensating balance requirement. Since this loan is outstanding for 3 months only, we have to annualize it by multiplying by 12 divided by 3. That would give us an 11.43% effective annual rate. Same case, next assumption. What is the effective annual rate if it is due in a year and has a compensating balance requirement of 1,000 pesos, earning interest income of 3%? In this case, we are going to have an interest income as a result of putting the amount of funds to the compensating balance. What we need to do here is to simply offset the interest income that will be earned from the compensating balance from the amount of interest expense. So we would have effective annual rate equals to 10% times 10,000 minus 3% times 1,000, the interest income, divided by 10,000 minus 1,000. That would give us an effective annual rate of 10.78%. So those are more complex cases involving discounting and compensating balance requirements. Moving on to the next financing source. It is possible for the company to arrange future financing by putting up a credit limit. A line of credit is a predetermined limit on how much a business can borrow from the bank. To demonstrate how this works, let us refer to the following calculation. The analyst for GTH Manufacturing has estimated the operating cash flows for the first quarter of the year as follows in Philippine peso. GTH has a line of credit of up to 3 million pesos on which it pays an annual interest of 12% payable monthly. Beginning balance for the year, cash, 2 million pesos. All cash flows occur at month end. So how does a line of credit work? The company need not borrow any funds if there is no need for such. Thus, the timing can be controlled by the company. Let us first have the projected cash flows throughout the first quarter. So we have January, February, and March. Let's begin with the cash inflow. Cash inflows would be 2 million, 2 million, and 4 million, respectively. Now for the cash outflows, we would have 3 million, 5 million, and 4 million. Let us leave a blank space for the financing cost or interest expense. So we would have the following net cash flows. For January, that's negative 1 million. Let us look at the beginning balance of cash. That is 2 million pesos. So we would have at month end an ending cash balance of 1 million pesos. This would be the beginning cash balance for the next month. February, that's 1 million. So no borrowings from the line of credit are required for January. Let us go to February. Inflow of 2 million, outflow of 5 million. The net cash outflow would be 3 million. At this point, note that the beginning cash balance is only 1 million. So by month end, it is expected that there would be a deficit of 2 million. As a result, this would be the time for borrowing using the line of credit. So if GTH Manufacturing will be going to borrow, by month end, there would be interest. So that's 2 million times 12% 1 month, that's 1%. You have 20,000. The interest expense that will be incurred by March. So come March, the projected cash inflow is 4 million and an outflow of also 4 million. That's a net inflow of 0. Considering there's an interest expense of 20,000, we would have a net cash outflow of 20,000. So if the beginning balance of our cash, we have a deficit of 2 million, so there should be an additional borrowing of 20,000. So the total borrowing by March would be 2,020,000. How much is expected to be incurred for the first quarter? That would be 20,000. No drawing of cash in January because there is sufficient cash. But in February, considering we assume that cash flows happen at year end, there is a deficit, so we have to borrow. So come March, there will now be an interest charge. By the end of March, there is 2,020,000. This is the net borrowings throughout the first quarter. Next, A formal type of credit line is a revolving credit agreement. This is very similar to the line of credit except that it is more formal. In a lot of cases, the bank charges a commitment fee to offset any amount set aside or not borrowed. To demonstrate how a revolving credit agreement works, let's refer to the following. KEC arrange a revolving credit agreement amounting to 1 million pesos with a group of small banks. KEC shall pay a commitment fee of 0.5% for the unused balance and 9% for the used balance of the credit line. KEC borrowed 600,000 pesos throughout the year. How are we going to arrive at the total financing cost? Well, let's begin with interest. The interest expense is 9%, that's the rate, times 600,000, the amount borrowed, we would have 54,000. Because the bank has set aside 1 million pesos for KEC, it would be unfair for the bank if there's no compensation as a result of setting that money aside. So for the remaining 400,000, the bank will charge a commitment fee. 0.5%, that's the commitment fee rate, times 400,000, that is 2,000 pesos. The total finance cost is 56,000 pesos. Now, let us go to other financing sources that does not involve banks. Commercial papers. A commercial paper is a short-term debt instrument, maximum maturity which shall not exceed 270 days. They are issued by large and stable companies only. In short, small companies, those with no track record, are not allowed to borrow via commercial papers. What is unique about the commercial paper is that this is open to the public, open to the investing public. As such, as I have mentioned a while ago, banks need not be involved as lenders. Anyone in the investing public can be a potential lender, thus making the interest rates generally lower compared to bank loans. These are the financing alternatives that businesses can use to finance their working capital requirements. So this would be the concluding topic for working capital management. Comment below for any future topic requests. Like, share, and subscribe.